Hi, Scott Nelson, Senior Wealth Manager and Portfolio Consultant with Boulay Financial Advisors. Going forward, we're going to shift the focus of these quarterly videos to cover more investment topics that we hope will help you better understand how we manage portfolios. This quarter, we look at why we are currently using so many short-term bond funds in client portfolios. That is, bonds that mature anywhere from a few months to a couple years versus longer-term bonds that mature in 10 or 20 years. We started shifting to primarily using short-term bonds in 2021 when it became apparent that the Federal Reserve would need to step in and raise interest rates to combat inflation. The Fed aggressively raised interest rates in 2022 and 2023 to the degree that, as you can see in the chart, two-year Treasury bonds, and by extension most short-term bonds, began paying rates that equaled or exceeded similar bonds with much longer maturities. That situation really didn't reverse until late 2024, and the difference in yields remained much less than it was 3 years ago. This narrow gap allows us to give clients most of the return of long-term bonds without most of the accompanying risk. You may be wondering why the yields on longer-term bonds have not moved up to the same degree as short-term bonds. Well, one has to appreciate is that short-term bonds are strongly affected by the Federal Reserve, but the yields on longer-term bonds are mostly determined by the bond market itself. At its core, the bond market merely reflects where bond investors expect long-term interest rates to be in the future. Whether logical or not, most bond investors have only experienced long-term bond rates of 6% or less over the last 20 plus years. So they may have been assuming that the Fed would quickly cut short-term interest rates, thereby making current long-term rates attractive again. But there's also likelihood that they've underappreciated just how stubborn our current bout of inflation would be. So while the Fed did cut short-term interest rates to a degree in late 2024, it appears that the Fed's battle with inflation is not over. Inflation, as measured by the Consumer Price Index, has risen now 4 straight months, reaching 3% on an annual basis in January. The economy has also held up very well, as evidenced by the January jobs report that showed that unemployment rate is now back down to 4%. Stubborn inflation, together with a strong economy, has made the Fed's decision in January to leave interest rates unchanged an easy one. So until the gap between short-term and long-term bond rates shifts significantly, we'll continue to allocate predominantly to shorter-term bonds. So we hope you now have a better appreciation of our approach to bond investing in early 2025. As always, if you have any questions about what was covered in this video, reach out to your Boulay financial advisor. To learn more about Boulay, please check out our website or email us at learnmore@boulaygroup.com. Until next time, take care.